All right. Hello, good evening, everybody. Welcome to our Investors Coffee Time at 8 p.m. Today is Saturday. And I hope that those who have actually attended our 3 p.m. members only uh, presentation on the semiconductor industry, right? Peter Lim has actually given quite a comprehensive analysis on the semicon industry, and hope that this will actually give you more idea on the semicon. In fact, I've never looked at Peter's presentation before, but I think he did it. What he did was having more detailed, analysis on the semicon industry. Like, so I hope that this will give you some information, and there's a lot of information in fact on the semicon industry. All right. Now today we're gonna talk about the pitfalls in investing, and I guess each and every one of us has gone through mistakes in our investment journey. And one of the reasons why we actually learn from investors is because we also want to know their mistakes, and so that we don't repeat them. And some of these mistakes can cost us quite dearly, right? So that's the reason why this topic I think is quite important for all of you guys, especially those who are still new to investing, right? So that you can try to avoid these pitfalls in investing. Okay, so before we start, as usual, we have to give this disclaimer first. Please note that the content of our discussion does not constitute any investment advice. It is for educational purposes only and informational purposes. Right? Please seek the advice of a qualified investment professional should you want to purchase any shares, investment products, or services. All right. Okay, investors copy time. We all know that. So for those who have joined us since day one of, and we started this, when the MCO started. So it's more than a month already, and be assured that although the MCO may be over, we are still going to be here at 8 p.m. on a daily basis, right? So hopefully that you are able to join us and also share with your friends, okay, so that they too can also benefit from the discussions that we have here on our investors copy time, right? And it's 8 p.m. So all you need to do to get notifications from us is to like our Facebook page, okay, and that is Equities Tracker. So you just go to facebook.com/Equities Tracker, or you just search on a Facebook, search for Equities Tracker, all right? And once you have got in, if you have not liked the page, please like the page, because that's how you can get the notification, right? And make sure that you also follow us, right? That's where you can actually get a notification, and make sure that your notification is on, right? So that you can get notification from us whenever we have a live session or whenever we post something which is important for you guys to, or some articles, then you get a notification as well. Now the copy time is also on YouTube, on the Equities Tracker YouTube channel. So you just go to Equities Tracker or search Equities Tracker on YouTube, and you should be able to see our logo over there. And make sure you subscribe to the YouTube channel, because if you are unable to access the Facebook page, you can still access it on the YouTube page. All right. So please, and last thing is, please help us to also share this with your friends. It's important that we have more people. One of the reasons why I mentioned to you guys earlier that we want to have more people on our copy time is because then we can invite more people, or more guests, especially CEOs of companies. When they see that we have a lot of people actually watching copy time, then they will want to come and actually talk to us, right? And we can also bring other experts in the industry as well. So please help us to share this to your friends on Facebook. All right. Okay, so I'm gonna start off first. Each of us will basically share what are the biggest mistakes that we have made in our investing journey, and also what we can learn from there. All right. So I'm not sure, because I'm not sure whether we have the same mistakes, but I'm sure because we are all from a different uh, background when we started, right? Because for me, I started as a trader, right? And I've been doing a lot of trading 20 years ago. And then Alvin, of course, is a purebred value investor. And of course, Peter Lim has been a fund manager, so we also basically want to learn from him. So the good thing about this is that Alvin and I may learn from Peter as well, right? And we actually learn from one another. And if you guys have any big mistakes as well that you have done, you can also type in your comment section, right? So that everyone will actually know what were the mistakes, and hopefully that we can learn with one another. All right. Okay, so I'm just going to start off with mine first. Okay, in this industry that I've been in for the past 20 years, I basically wear two hats, right? I do make some. I wear an analyst cap, all right. Of course, based on technical analysis, lah. And I'm also a trader myself, an investor myself, right? And sometimes these two can conflict with one another. Just give an example, right? Because in analysis, when we have an analysis job, we always give an opinion towards the market, right? Because we need to tell you how high the market is going to go or how low it's going to go. That was what I was doing, even when I was working in a stockbroking firm for a short period of time when I was a technical analyst, right? We give opinions towards the market, right? So there's once, I think it was in year 2008 2012, right after the market rebounded in 2008. So despite after having so much experience, we do make mistakes sometimes as well. And one of the biggest mistake that I made was, if I was just I follow the market, I could have probably made more, right? Because in 2012, and our market actually rallied until 2014, right? I gave an opinion that thinks that the market was already at the top, right? And when you have an opinion that the market is toppish, you will just keep on, holding on to your opinion and thinking that the market is going to come down, right? And because of that analysis, and we do not want to change our mind, like, it doesn't look good also, right? Once you make the analysis, for example, right now, if the market is going to go to 2,000 points, we're going to hold on to that 2,000 points, right? So what happened was, the market keep on getting higher in 2012, but I've already sold off most of the positions. Okay, and I did not buy anything for the next, actually nearly 6 months, because I opined that the market is going to come down, right? What I ignored was basically the information from the market. Okay, the chart say it was still very bullish. Fundamentals are still going quite strong. Okay, but because of my own opinion, then I made a wrong decision. Okay, because I hold on to my opinion. If I were to follow the market, okay, follow the data that's available in the market, whether it's price analysis or even fundamental analysis, I would have not been so bearish. Okay, so my mistake, and I did this before also, actually, when I started in trading. So that mistake, although I've learned, but I repeat it again. Okay, that was in year 2012. So market keeps on getting higher, and I miss a good opportunity to even make more money, right? So I guess, again, it's very important that everybody can give opinions towards the market, right? And his opinion is basically just that, opinion, right? I can give an opinion. If you ask somebody else, they may give a different opinion. When we had this copy time for some time also, everybody was looking for our opinion, right? Ask Alvin, ask Peter whether the market has bottomed out, whether it's going to go up, right? Or whether it's going to come down. Okay, but those are all based on our opinions, right? And because of that, it made me lose opportunities, right? So I told myself, you know what, it's no matter what, at the end of the day, I think the market is always right, and I should have depended on the data, on the data itself, instead of listening to my own opinion. Okay, so sometimes opinions can be wrong. Okay, and in fact, most of the times I think it's wrong. Okay, Mr. Market is always right. So since then, I just keep on following what the market says instead of listening to my own self. All right. So that's my story. If we go through with Alvin and Peter in a short while. If you have more time, then I can share you one more story. Okay. Like I said, if you have any other mistakes that you've made on your investing journey so far, please type it down on your comment section. All right. So guys, anyone else want to start now?
Peter, you're next, right?
You wanna go first, Peter?
I just unmute first. Yeah.
Yeah, me. I guess I'm still having this problem. I think my biggest mistake is actually I tend to fall in love with stocks. I think that's the biggest problem. I mean, many times, the stock I invested, I mean, it went up a lot. But then because you develop a certain kind of attachment to the stock, right? That even when it's time to let go, you somehow will find reasons that why you should be holding on. It's very easy to say on theoretical, right? Buy low, sell high. But once you make a lot of return from certain stock, right, there is a certain attachment that you wouldn't want to let go. You're still convincing that somehow that there's still value to it. It will go higher. That the fundamentals will be good, so on and so forth. So it's all these noises inside your brain that's going trying to convince you why you should be holding on. I guess that is one of the biggest mistake. And I'm still making it, to be very honest with you. That's why my resolution for this year is my lesson tagline for this year is what was it again? I think it never kills anyone by taking profit. I think that will be my tagline for this year. Yeah. Somebody told me that word. I really can't remember who gave me that sentence, but it makes sense to me. So this will be my mantra for this year. So sorry, I remember no one has ever died from taking profit. I think that's the tagline.
But on this topic about taking profit, I think taking profit is a lot more difficult than buying a stock.
Yeah.
It keeps going down. I think that's probably the easy part, right? I think taking profit is like a completely brand new skill set that you actually you have to learn. And I don't think it comes natural. I don't know if you guys agree or not. As in, taking profit is not natural for a lot of people, or even cutting losses.
Yeah. It's not easy. I mean, I opposite. I have no problem cutting losses. I somehow I'm quite a weird situation, right? I'm quite easy to actually admit I'm wrong to cut losses, but to take on profit, I think my problem is there. Oh my gosh.
I'm saying that it's very, very normal for most investors to unable to take profit, because I think they are more afraid of taking profit now and the price going higher. That fear, right, is greater than actually losing money somehow. I don't know why. Can't explain it.
Yeah. No, actually, mine is not so much of the fear of missing out to gain. It's really, to a certain extent, it's more really like, this is for me personally. This is my problem, right? It's really more of an emotional attachment to it, that you suddenly really like the stock. So even though that the valuation is high, that there's really so much more further growth you can squeeze out, but because of that emotional attachment, then you tend to hang on to it.
Yeah, agree. Yeah. Hey Benny, you're mute. Benny.
Yeah, sorry. Yeah, I mean, like you said, right, making an entry is easy, right? Because you can just click, and then because you have not made money, you have not lost money. I think that's the easiest part, right? And cut loss, people say it is difficult, but taking profits like Peter Lim can also be difficult, right? Because I always get an example. If you can make money in the markets, you are already probably much better off than many people already, right? And whenever I also teach about trading is, you can never buy at the bottom and sell at the top with great consistency, right? Sometimes it's just pure luck, right? But the great at consistency, if you can even make just little bit of that rally, you can make some money out of it. I think it's really quite good, right? But it's again, Alvin, I really agree with you. Is Peter also is an emotional state, right? Very, very simple example is whenever we trade. I mean, we talk about short-term trading. Is we actually set a target, right? And when the price reach the target, already you think, I think can still go up some more, because you already felt the money is there with you. It says, oh no, I just have to ride on this thing, and then we raise the target higher. Okay, and then when the target price don't reach, and then it start to come down, and we do not know what to do. Right, that's when the problem. I think one of the other things that I found out in my years of trading is once you have a plan, make sure you stick with it. Right? That's the safest, because you already planned this out, right? And if you make a decision not based on the plan, that means we are actually diverting from our original plan. So that's what I've learned so far. But for me, it's not about. For me, my biggest fear of making a mistake is not that whether I can follow that trading plan that I've already put in, is whether I can follow it or not. All right, that's my biggest fear. Okay, and that comes to and even taking profits or cutting losses, lah.
I think that is yeah.
Sorry,
I think
yeah.
no, I think Ricky once put it on a very good perspective, which I totally agree. You were saying that I mean, this for me, not for you. You're saying when there was this question of when do you sell or when do you sell? Not say cut loss, but when do you decide to take profit? And then his explanation is when the reason that you buy in the first place is no longer true or no longer holds true. That is when you sell. You see, even think about not selling at the high, right? I have all sort of experience before. I have those where it went high, I didn't take profit, and the thing fell. I make profit, but I make a much lesser profit than what I could have made. And there are also examples where it went up, I didn't take profit. Of course, the price went down, but then I hang on to it. In some cases, I hang on to it like 1 year, even more than a year, and subsequently the price also recovered back or even surpassed the high. So in reality, I don't think that there seems to be no. That's why it's very hard for me to actually come up with a mindset of when do you actually take profit, because there's so many different personal experiences which actually give you very, very different conclusion. I guess this was something I'm still trying to cope with in that sense.
Yeah, I agree because sometimes as a value investor, you say let you're buying the business, if business is doing well, right? And then you sometimes remind yourself, imagine if I had bought, let's say, Public Bank or held on to Public Bank or Amazon or Microsoft, all those guys over the 10-year period, I'll be much better off. And then you sort of convince yourself, you know what, maybe I'm a value investor, right? And then you see go up and then come back down again, right? So it is very conflicting. I agree with that. There is no right one answer, So like you say, I also agree. I say it's never wrong. So my mantra is never wrong to take profit. Just never wrong. Okay? If you're making money, you take some profit. It's never wrong, right? Even if it goes higher, it shouldn't matter to you.
But then, okay, of course, I've also seen fellow fund managers, right, who use a trading style. Okay, when the thing goes up, they say, okay, I'm going to trade because I believe I'm going to be able to buy lower. But you see, it is a mindset. So when they meant to sell, when the price start to correct, right? No, the sense of getting right. They say, okay, I'm right? Okay, the price is corrected. But then their grades start to come in. They say, no, I'm able to get lower. So even when the price corrected, they didn't go in. And guess what? When finally the price rallied and surpassed the previous price they sold, then they start to buy back. So I've also seen the cases where people try to time it and try to take advantage of timing. But on paper, it sounds very easy. Oh, you should have bought here, you should have sold here, you should have sold and bought here. Right?
Yeah.
But when your emotion comes into play, I think that's again very, very difficult. Like what Benny said very correctly. You see, you just assume if you're a trader, to complete a trade, you need to buy and need to sell, right? That completes the whole trade. And assuming you're a very, very good trader, and I give you 70% accuracy in timing on when to enter, when to exit. I mean, 70% accuracy, that's pretty good, right? So if you look at your simple mathematics, right, you're 70% correct in entry and you're 70% correct in exit, the combined probability of you making a correct trade is only 49%. Right? It's probability, right? It's mathematics.
Yeah. Oh, that's less than half.
Less than half.
Yeah.
So very high chance to lose money. I guess you just put it mathematically. And why most people lose money, right?
That's why I do say it is my biggest mistake that I tend not to sell shares at the top, right? But why until now I'm still making the mistake, quote unquote, because not all end up as a mistake. There are really some example where it goes up, I didn't sell, it goes down, but after a while it did recover back to where it was. So that's why I'm still able to adjust my mindset. I will still call it a mistake. I mean, for reality purposes, but it is not like an absolute mistake where it fails every time. You see, there are some times where actually it works to my advantage in that sense.
Yeah, I totally agree, because there are a lot of people out there, right? That I mean, of course, they are trying to promote that says, I got a 90% accuracy and 80% accuracy and this kind of stuff, right? I mean, Peter, you've been in industry. I also know many traders, right? And none of them can actually claim that they've even made 70% accuracy and above. Right? And I'm talking about real guys who actually make money through trading and investing. Not someone who probably just on the stage and talk, right? I mean, like you said, Peter, you actually can, on hindsight, right? That's what you're mentioning. Because you see the chart historically, of course, you say, oh, this is the best time to buy, this is the best time to sell, right? But the biggest question I always mention to all those who actually follow me as well is that the right hand side of the chart is still pretty much uncertain. Right? So of course, there's always a fear when you don't see that part. There's no fear when you see the history because it's already all past. Okay, so that's what the problem is, right? But of course, like in trading as well, for me, if I get something that is 50% probability, I'm actually quite happy. But people are thinking 50% how to make money, right? Okay, so I always emphasize on this, right? Is whenever we make a decision, make sure that your potential upside is more than your risk. Okay, and if you are able to do this more frequently, right, and whenever you make bigger than your losses, there's a lot of traders. People think, hey, why cut your losses short? Why cut your losses short? It's because you want to minimize that risk. And when you catch one big or two trades, that's how you cover back your money. But the only problem with this, right, because the uncertainty that we have is like, I don't know whether this is going to be a winning trade or losing trade. Because even if it's 30%, let's say, right, 30% chance that you're going to lose money, but that 30% can happen in the future. And if you're not prepared for it, that's it, that's where our confidence come down, right? So yeah, guys, one thing is that, I mean, if someone can actually claim that they get 70-80% and above, you know what, I also want to go and take the joysticks and pie it a flirt and and learn from him also because I've never seen one.
Right? Yeah? There are a lot of Facebook ads now. They are doing that, right?
It's crazy, of course. I mean, if I open up a workshop, right, that says, you know what, I'm going to teach you how to make 50% winning trades.
Let's be realistic. Let's think about this. I mean, I say I'm going to offend people by saying this again. Shit, but you say think about it. If their accuracy is so good that they can really make trade money, I'll ask the same basic question: why do they want to waste their time to train you? Right? Might as well they sit on the computer and trade, and they make more money doing that rather than spend the time to prepare to go and talk to you about it, right? But the fact they rather spend time to teach you how to do it means they're actually not making money by doing the trade.
Yeah.
Coming from.
And that's one of the reasons why that's one of the reasons why I don't believe in black box systems as well, because if I can create a black box, a software that gives you the buy and sell signal, guys, I would not even want to sell to you guys for like $500 a month or $600 a month.
Exactly, right?
I think these are the things that I know if you have gone through, right? So that I know, of course, those guys we are here. I mean, we have been with us. We know that we are here to actually provide you the information and trying to get you to look at information and make your investment decisions in a well-informed manner, right? And not just simply follow what other people say, because that was one of the mistakes I make as well, right? When you look at the data says it's a good opportunity, but people say it's a bad opportunity, then who's to follow, right?
No, interesting. This again, realize I used to have one colleague during those days. Remember the before the Parkson, it was called known as Lion Diversified. So that was 04, 05, 06 period during those times. I remember that time our cost was very low. I think our cost was around plus minus 70 cents. So I have a colleague who told me, he said, if the price ever hit 180, he's going to sell. Because from 70 cents, 180, you're making a hell lot of money. And it did. I think in less than a year, it actually hit 180, right? So then, of course, it sell and making so much money from it, right? And guess what? In the next 24 months, the share price went up to $9. So really hard to say. So technically, taking profit has not killed anyone, but it can make someone suffer quite a lot.
Pain.
Okay, I think we take some questions from those. At least we try to answer some questions before we go on. Okay, there's one. Maybe you guys can also look at the question, but I got one from Lee Xiao Wei. They said there's uncertainty in the market. We are not God. Very true. Okay, how can you time the market? You won't know what will happen in the next round.
Timing is yours.
That means your question, man. I'm right?
No, mind, because after this there will be a question for you also, Alvin, on investing. So I guess I'm going to answer this one first. Yes, there is this uncertainty, right? There's always this uncertainty in the markets. But what we are trying to do in technical analysis is basically to study the historical prices, so that and if you are able to understand the market behavior, it gives us, of course, not 100% certainty, but some certainty that the price will go into a direction, right? And if it does not go to the direction that we anticipate, because as a trader, we always have anticipation. Okay, if the price moves the way we expected, that means we're still going to hold on. That strategy that you're doing is correct. But if it moves the other way around, we have to basically cut loss, right? It's not moving to the way that we expected, and you have to get out in the short term, right? If you are talking about trading, right? And like I said, even if you have, let's say, a 40-50% winning probability, and that's like making 5 rights and 5 wrongs, you can still make money, okay, as long as your winnings are more than your losses. Now, one of the things that a lot of people do is people tend to do a lot of back testing, but they don't do forward testing, right? That's where you actually test whatever your certainty in the past when you did analysis. For example, you can get a trading plan where you have 70-80% winning probability over that period of years. But when you start to test it forward, the results may be different, right? So again, if you really follow it, and the most important thing, I think we had this session 2 or 3 sessions ago. What was more important, right? The master key to investing and trading. Okay, and I think the master key, like Alvin and Peter has mentioned, is not the stock picking, but it's how much, right? Building the portfolio is how much is the quantity side, and a lot of people actually forget about that. Okay, so I think that's how you manage that uncertainty as well. Okay, so that's my answer.
I think the two most underrated things that are talked about in the stock market when it comes to stocks are, number one is how much of it should you put in your portfolio, your quantity. Number two, when to take profit. No, in my years of training and teaching, everyone always asks what to buy. I don't think anyone has ever asked. Of course, I cannot give you buy and sell a whole course, but the question still comes like, should I buy this? And the funny thing is, they always ask me, what do I think of this stock, whether I can buy or not? And I can almost guarantee 90% of the time, this one with high certainty, high probability, they already bought that stock already. They just want confirmation that it's okay, from someone else, right? And the second one, I think most underrated things that have never been talked about is when to sell, So it's how much and when to sell. We always focus on what stock to buy, and that's most of the time. And whether it's a good time to buy, those are two most. So if we sort of spread out some of our efforts around these 4 questions that needs to be answered, right? I think you probably have a much higher probability of succeeding in making money.
Yeah, I think I can answer that, Alvin. Why?
Why?
Because whenever we attend a seminar or a workshop from, let's say, a broker or whatever, right? They only talk about buying only, what? Right? What stocks to buy now? But they didn't tell you how much to buy and when to get out. So that's why our mind is so programmed. Whenever you go to a seminar, this is what I'm expecting. What stocks to buy? But I think buying is just one part of the whole trading plan or investment strategy. You have to really look at other stuff as well.
Yeah. I think it's probably a very small portion of it's just an action that you need to do, right? But I don't think a lot of thought has been put out through the whole plan, but mostly just the first 2. Is it a good time to buy now? What stock to buy? That's always the case.
Okay, so the next question now is for you, Alvin. This is from Aswin Singh. So if you're a value investor, how do you set your cut loss? All right, when to get out? When fundamental change for 1 or 2 years?
Yeah.
So how do you exit?
I saw this question. I think I get this question quite a lot. Maybe I'll share with you guys some of my massive failures my wrong calls. Let me just share my screen. Let me see if I can share my screen. Give me a moment. I've got the equity tracker set up so you guys can see, right? Perfect. So one of the when they were talking about pitfalls, I was like, wow, I got so many. I've fallen into so many holes before, right? Which one do I actually want to use? So I'm gonna give you a bit of background history, right? So I've done quite a fair bit of work on hard disk drives, right? Or hard disk industry. I think today in the semiconductor one, we talked about it. I think it was back in 2010 or 2012. I kind of started digging quite deep. And really, if you look at the Malaysian market, there's really only very directly related. 10 years ago, you got to remember this. Only three guys, JCY, Dufu, and Dufu wasn't even listed yet 10 years ago. So it's only JCY, and JCY was newly listed, and it was only Notion. Notion was the only one listed 10 years ago, right? There was very heavy exposure to hard disk, directly to hard disk. And I remember going in, and I mean, one of the reasons is I should have taken profit earlier, but I still made money. But that's not the point. But at that point, the total number of hard disk drives actually started coming down because SSD started kicking in, right? Solid state drives. So actually, I bought it. I made it. I bought it when it came down, and then when it rebounded, I didn't take profit. That was a big problem, right? But by the time it started slowly declining, there was no specific time period. But I remember very clearly, Andrew, if you all remember Andrew, right? Andrew was telling me, hey, Andrew's my older brother also, by the way. He was saying that, hey, I think hard disk cannot. I said, cannot lah. Hard disk, every laptop, a desktop also got hard disk, right? How can you say, right? He said, no, actually, I recently just went to the shop, upgraded my laptop to a SSD, right? And a lot of people are doing it, and it's really not that expensive anymore. Yes, it's more expensive, but if you really want that performance, that's how it is. Now, then you see the TAM, or total addressable market, for actual hard disk drives keep coming down. So one of the things is that, although I looked at the data, I looked at a lot of historical data, but one of the things that happens is that trends keep changing. So that was the first one. Subsequently, the second one that I went into, just to give you guys an idea, was JCY. JCY, I think I did it maybe 3 years ago. The price that I went in was about 50, 60 cents. So when you look at the data itself, if you look at 2016, yes, they made a loss. Maybe I should just zoom in a little bit. But you see, I mean, I cut loss eventually because I realized that my analysis was wrong, right? And so one of the points where it showed that my analysis was wrong is this. If I look at my quarterly results, I think those members who've been with ET for a while, you guys will definitely remember this. Please don't kill me. I do apologize. I was wrong about this, okay? The numbers look good. There are a lot of cash, right? And at that point, it was showing a 10% dividend yield. So I was thinking, what could go wrong? But what happened if you look at this? Subsequently, almost every quarter, this is 2017. I look at 2018. Every quarter they were losing money. Every quarter, right? I think after about 12 months, this is 2018. If you look at 2019, I'll show you guys. It's almost every quarter is negative, right? So at some point, you must believe in the data and say, look, you were way off, and you were wrong, right? So actually, I did exit. I think initially I went in about 50 plus cents. I think 60 cents. I exited. I lost half. I was out at about 30 plus cents, right? So I think in terms of time frame, I don't have that specific time frame because there are times where it be shorter, there will be times where it's longer, right? But I think one thing that like what you said earlier, you have the opinion, which is fine, but you need to know when you're wrong, and the data will tell you when you're wrong, right? So so really, as much as data driven as I am, sometimes it is in the mind, right? So actually, of the three, can you imagine? I picked. Of course, I'm not saying that. I mean, these are the stocks that I picked, but the third one, obviously, it was listed today, is Dufu, right? Of course, at that point, I could have also bought Dufu, because if I had bought Dufu, I think my returns would be easily 5 times, right? Because I missed a very important element in that research, right? Which was the part they were actually making. So that was that was. But stay tuned. So we're gonna probably do one session on storage or future of storage in a couple of weeks for the club members or for the subscribers of ET, right? We will be doing an in-depth one. So I've done a lot of research, but I might as well just share it. It's the same. And just to give you guys an idea of the landscape of what it is. So there's no specific time. Rather, it's when you realize that you are wrong, right? Yeah.
Yeah, Peter, you want to share based on your experience on as a fund manager, right? When do you know that you are wrong? Or you never wrong?
As a fund manager, we were never right.
All right, something new. I want to listen.
Yeah, I see. I think I'm not sure you all still remember I mentioned this. But see, the problem with the fund manager is this: if you invest in the wrong stock and you lose money for a client, your client will think you're very stupid for making losses at this by investing in those stocks, right? I mean, they will say, why don't you invest in other stocks? But when you make money for them, again, the credit don't goes to you. They are the one who is smart for picking you to manage their fund. So either way, you never get any credits. It's true. It's really, really true. Yeah. I tell you, being a fund manager is never fun. That's why I always advise people, right? I mean, look, if you have your own money to invest, why the hell do you want to be a fund manager and manage other people's money and get all the stress for yourself?
I agree.
Very true. That's one of the reasons why also whenever a family member, because they know that we are investing or in trading, right? We're investing our own money and all that. But if you ask them to give advice, I think that's the most difficult part, lah. Especially family members, like you feel more pressure, right?
Oh gosh.
So for those who are my family members hearing me, and some of them be asking me, and you know that I will say no, lah.
Actually, I got a lot more war stories. There was one which was quite interesting. This was an Aussie stock. I think those who have been following long enough. This was probably the most research stock that I've done. It was actually a silver mine, and just to share with you, I went to this place 3 times, right? And it's almost 4 hours from the city, right? One way. And I used to do day trips, and I went 3 times, okay, to the actual mine site, right? And after doing everything and investing, and I mean, doing a lot of research, and when you try and value a mining asset, right, it's very different. You can't use PE, it doesn't make sense, right? Because it's not recurring, right? And I think one of the biggest things that it subsequently failed, it didn't work. But the main reason was because I checked on receivables, I checked everything. But one thing I didn't check was the payables, right? So what happened was the moment the money went in, all the money went out to sorting out the payables to restart the mine, which then put them back at square one where they had no working capital and they were asking for working capital again. So that was a very painful lesson. But effort, sometimes effort doesn't always equal success. It's effort in the right direction equals to success. Yeah, so even missing out these small items, actually you really do miss out, right? So sometimes
Yeah, actually it makes sense. There was this saying goes, right? Practice makes perfect, right? Actually, I totally don't agree with this, because if you think about it, if you're practicing the wrong thing every time, you are perfectly wrong. It doesn't make you perfect.
Yeah.
That's very true, lah. I think, but it again all boils down to the mindset, right? Because especially for those who want to look for very short-term profits, right? And anyway, those who normally ask for making money the shortest time possible and the fastest possible and the most possible are those who have probably lost money before, right? Because they want to make back their money. So I mean, in trading, there's actually money management also, and not many people actually know there's actually money management. There's also position sizing, right? And traders tend to do the other way around, like Peter mentioned, right? If you already lost money in the first place following a strategy, you should not be adding up more positions, right? But people tend to add more positions because they want to cover back faster, but they're following the old same technique, right? So I always encourage that, especially for those who are still new to whether trading investing, is to actually start small first, right? And once you see the fruit, once you see that it's working, then only you should be adding your positions, right? Not the other way around. But I see time and time again people adding more positions when they lose money. Yeah, that's very
actually,
ironic.
that's it. There's actually two types of stock. The first type of stock is stock that goes down, that will come back up. The other type of stock is it goes down, it will go down even further. Look, there's this. Someone taught me this. They're asking me this question: what do you call a stock that has gone down by 90%? Right. So the definition of a stock that has gone down by 90% is a stock that has already gone down by 80% and still can lose half of the value.
That's very true. That's very true.
Right? I mean, just when you thought you already go down 80% already, let's go, you will, it can still lose another 50%.
Yeah, correct. Yeah. Okay, so there's a question here from Karina Lee. Okay, can you share your experience of achieving 10x on an investment? Are there any specific criteria and characteristics to search in a company or stock? 10x. Karina, you didn't put a time frame, so I do not know the 10x. When do you want to achieve that 10x? All right. But I think she's referring to one particular stock. It's a 10 bagger lah. Have you guys achieved any stocks that is a 10 bagger?
Yeah, there's a few. But the one that was the most memorable was actually Time.com. It is one of those where, okay, is it Time.com up to 2011 plus minus, right? It's still a penny stock. I think that the price was around 30 cents plus minus. And it was highly volatile. The prices can swing from 25 cents to 30 cents, back to 25 cents, 30 cents, can swing around that range. But don't forget, every 5 cents swing for a 30 cent stock is quite major, right? So it was a very tough call. I like it, so I was having a very high conviction on it. So of course I have it in my portfolio. So my portfolio went yo-yo like the shares. It's very, very volatile. But subsequently, what it did was the conviction pay off, and they actually, okay, the 30 cent is not, you can't compare now. There was a merger of shares 5 into 1. So on average, say your cost is around 25 cents. So if 5 into 1, it becomes around how much? Around 125 plus minus, right? So your plus is around 125. If you compare the price now at $9, but if you add in the DG shares they give them back to you, on all those things that they have, a corporate exercise they have done, you have easily made 10 times from plus minus 2012 until now in the last 8 years. Yeah.
Okay, so the extension of the question is: do you have any characteristics of identifying this kind of stocks? How to identify?
How to identify is, first thing is you must really know the business well. What gave me that confidence despite the very yo-yo period was, I say I do quite extensive research on telecommunications way back then. So I did have quite a grasp on, I won't say a very good grasp, but I really know the fundamentals of telcos. So I can really see where the direction is going on. So even that time I was having this thought that fixed line is going to dominate the industry with all this broadband and whatnot. So that's number one. Second is when I look at the strategies that the new management has been doing, it makes a lot of sense, and I think they're heading at the very right direction. So it's a mix of criteria. It's good business, good position, good management, and they're in the right industry.
Alvin, have you got a 10 bagger before?
Actually, that was a good question, and it really made me think. I think the closest I ever came to a 10 bagger was probably a 7 bagger. And then I look back at some of the ones that we've actually made money on. And I don't think they are even past 3 baggers. And then I think again, why not 10 bagger, right? There's 2 ways you're gonna get a 10 bagger, in my personal opinion, all right? You see, at Equities Tracker, we have this thing called the 6 categories of stocks, right? So we call them newly listed stocks, which is startup, emerging, investment grade or cyclical, emerging grade, cyclical, investment grade, sunset, or turnaround, right? If you're gonna get, so of course this is all due to time frame. If you say you got 10 bagger over 30 years, I think that's achievable. But you say you want to do a 10 bagger like what Peter is saying, I think 10 bagger, you'll hit 10 bagger in about 8 years, right? 8 to 9 years, right, Peter? Yeah. Time.com, right? 8 to 9 years. So that's a much shorter period. So when you say 10x is of course what period? And when I look back, I look at it, it's like, because I don't invest a lot of money in turnaround companies, right? Or when they're turning around, right? So I think like what Peter was mentioning to Time.com at that point, it was really a turnaround situation, right? As a value investor, maybe I'm a bit more conservative. I stick to my emerging investments, cyclical, right? Now some startup as well. But if you really want to hit those 10 baggers, you have a better shot. Like if you say you're gonna buy an investment grade stock today and do a 10 bagger in 10 years, I mean, it's got to really shoot through the roof, right? Their growth rate must be incredible, and yet they have very strong fundamentals, right? So I think you're gonna find them a lot in your startup or newly listed companies, right? You're gonna find that in your turnaround companies. Because if turnaround goes to emerging grade, becomes investment grade, like what Time has done, you're gonna get your 10x, right? Yeah. So my style is that instead of trying to hit that one swing and hit it out of the park, right? I spread out my portfolio. I'm happy to have maybe 2 baggers or 2 times, or maybe even 1.5 times, or even 3 times. It's already good enough if you have it in your portfolio spread out. So it's about balancing your risk. So that's why I say the closer I got to 10x is probably a 7x, and that was on not even a stock, that was on a warrant, right? Okay, so in that sense, it was leverage, right? So I mean, you got me thinking as well. So am I really looking for 10 baggers? I look at I rethink on my strategy. I'm really not looking at 10 baggers for myself personally, right? A 3 bagger or 2 bagger in 3 years, it's already a 24% compounded return excluding dividends, right? I think that's already pretty decent. So the question is, how much risk do you want to take, right? Of course, another way you can do 10x is very simple, right? You leverage up, right? You go and borrow 90%, you put 10% down, and then if it doubles, then you 10x, right? I mean, just to give you an example. So there are different perspectives, lah.
So what Elvin mentioned is totally right. No, to earn that kind of 10x or 10 but before I forget, the concept of 10 bagger was made famous by Peter Lynch. Not Peter Lim, Peter Lynch. Clarification.
I thought Peter Lim.
A lot to do is you need to go for either companies that's undergoing restructuring, or there's corporate exercises. That is where you really have a multi-bagger. Back example, remember the Lion Diversified example I mentioned? It went from a very short time from a few cents to $9. That was because there was a corporate restructuring where Lion Diversified just sold off the previous business, and they actually the parent company actually injected Parkson Retail into Lion Diversified. So that again, it was a restructuring that actually relaxed on. The other one which I make quite a lot. I can't remember. I think close to 10. I can't remember exactly how much. But I have my colleagues once told me actually I've made the most of that stock. I never really see and count, but when they were tracking me, they actually calculated that it was actually Technic. Not sure if you all remember, Technic was way back in 2014. Technic was actually a sister company of SKP Resources. They were owned by the same Gun family. So what happened was then there was a SKP. It was like a quote unquote, it's like a merger, where the family actually consolidated both companies together, where SKP actually bought over the businesses of Technic, and then Technic actually divvy out all the cash back to all the shareholders, and subsequently Technic got a new business coming in, which became your Rohas Technic as what we see today. And the whole exercise I held on to the Technic shares, and quite handsome gain from there. But the point I want to raise is it's true that if you really want to look at all this multi-bagger return, you really have to look at turnaround or restructuring. But then again, the effort you need to put in is extremely a lot, because you really need to be very, very sure you know what you're looking at and you know what you're doing. No free lunch. There is really no free lunch.
And I think this is where Ricky is pretty good. So tomorrow I'm going to see Ricky on the show. Ricky has done quite well with companies in a turnaround situation in the last 10 years. Actually, yeah, someone reminded, I think Vitrox, right? Vitrox was, we actually got him to come for one of our events, the CEO, Mr. Chu, back in 2012, December. If I look at the adjusted share price now, the price was about 50 cents. today is $8, right? But I exited after 3x.
Okay, that's the reason why I was saying VTROX. To be honest, I bought VTROX way back in 2013, right? I bought at around 130, right? So that's an adjusted price. Yeah, right. And when it was 170, I felt so smart. I actually sold everything. It is honestly, VTROX is one of my most painful stock. One of those that you really sold too early. That kind of, it is painful. It's painful.
I was 120. I remember. I think 360 or 380. I was out, right? And I thought
that's smart, right?
Wow, that's smart.
Okay lah, it's profitable lah still.
Yeah.
Oh, God.
Yeah, I never hold any stocks that even go. I mean, not long enough to become a 10-bagger lah, because my is always short term in nature. Okay. Anyways, so there's another question here. If you already sold a stock, I think this for Alvin, maybe as well. Once you have sold a stock from your portfolio, right? Do you add them back again later?
Yes. Okay. I didn't used to. And this is where the mindset change needs to happen, right? So can you imagine, right? So like we just thought about it, like Peter and myself, right? 170, and then we 120 and sold it at 170, or $1 and you sold it at $4, and you feel very good, right? But it takes it's not easy for an average investor to actually buy back again. Let's say I bought at 120, I sold at 360. Ask you to buy back at 550. It's very hard, you know. There is a mental block inside there, right? I used to have that mental block, but now I've sort of overcome that. Doesn't matter. And here's the beauty about investing: you can go in, come out, and you can also go back in again. And because you've already done that foundational homework, I'm not saying you don't have to do your homework. You already done that foundational homework. You can go and update your homework, double check again. And there you go, right? So it's not going to take you the same amount or the same learning curve again, right? Unlike if you look at stocks, look at property, for example, right? I buy a property and then, you know, it went up 2 times, 3 times. I can't reuse that same strategy again because I have to go and redo my research again. And that's the beauty of our stock. So I have done it, and I will continue to do it because it's a very clear mental block you need to get through.
Yeah. For me, it really depends on the reason why I sell in the first place. I mean, if the reason that I sell is due to valuation, that is purely a valuation issue, then of course there is really no mental block to actually buy back. But if the reason for selling is due to, for instance, distrust of the management, or you're no longer comfortable with the company, that I'm quite a clear-cut person. I will never look at it anymore. So even if the share price can become 5-bagger, 10-bagger, even 20-bagger, I am the type of person where if it's a company that I'm not comfortable with, no matter how high your share price goes, I wouldn't feel a single bit of pain. The only pain I will feel is a damn good company that I miss it and I see the share price keep going down. That I feel very, very painful.
Yeah.
Okay. Yeah. There's a question here that asks, because right now times have changed. I mean, we have not seen, this is unprecedented, right? This COVID-19 thing, because we have previous pandemic where it's only, you know, we don't even shut down the economy at that time, right? So the question basically is, you know, because there's a lot of uncertainty even in the future itself, do you change strategies or not during this kind of times when the market have not performed the way it used to?
I think I go first. For me, is if you look at it, you must really assess things on multiple aspects. I think a more important question is, whatever that happens, right? Does it change the fundamentals or the industry dynamics of whatever company that you invest in? I think that is a more important question rather than strategy. I mean, this for me personally, right? So what I'll do is that for whenever these kind of things happen, be it your great financial crisis, banking crisis, currency crisis, oil crisis, whatever that is, the first thing as an investor you need to assess is not about changing your strategy. The first thing you need to assess is, how does this affect the fundamental dynamics of the businesses that you've already invested in? Yeah.
All right. Okay. There's a question from Peter Law, not Peter Lim. directly to me because I was talking about forward testing and historical testing. Now, when you really dig deeper into trading, right? When we do back testing, you know, because in back testing we always try to find what we call the best combination of indicators, right? And there's a problem of curve fitting. That means we are basically shock sendiri lah. We curve, we adjust the indicators based on the performance historical data, and if the market changes a little bit in the future, everything goes wrong, right? So actually in trading, there's this thing when we do a back testing, we call it performance back testing, where we have many different kind of combinations and so on. There's this thing called a bell curve, right? I don't want to go much detail about that. That will tell you whether that parameter that you use will be able to stand against time, right? And the thing is that this, right? Because sometimes when we go to workshops, I know that these workshops are all still available right now. People who teach you about trading, you know, they teach you a method, and then after that, you know, 3 months later, they said, no, you know what? I think we have to use another set of indicators because it did not work now. This indicator should work in the future. And then 6 months down the road, it changes again. And it keeps on changing and changing and changing. And you know what? They keep on changing because they say, you know what? This is a better system. You have to pay more, attend this class, right? And keep on changing. Now, the thing is that if you keep on changing things, it simply means that it was not working in the first place, right? That means until now your stock is still not working because it keeps on changing. And that's one of the reasons why if you are trading, if you're using technical analysis, one of the things that I like to use most are not technical indicators, because technical indicators are a little bit too subjective. You have to change the parameters and so on. What I prefer is actually patterns. Because patterns is you either see it or you don't. It's so fixed, it's so objective, right? So for me, that's how I see it, right? So if Peter, you want to try, it's better to try on patterns, okay, and then try forward. And that pattern should work in any market condition, right? Of course, it's not 100%, right? But as long as you get higher winning probability, higher winnings than your losses, then I think you should be doing fine, okay?
I think that there's a couple of questions on YouTube. I think this is probably more suited for you. So there's one from YN Wong. He said, "How do you cut loss?" Number one, and how do you tighten your stop loss? I think this is probably a trading question, right?
Yeah, because we are. Yeah. For me is it's not really on tightening your stop loss. That means you put a fixed stop loss, like the price down on 3%, you go and cut, right? Or 5%, you go and cut. Because I never believe in putting a fixed stop loss, right? Sometimes the trading itself, the risk for that particular share, the stop loss may be 20%. Right? So question is, if it's 20%, that means you see the thing is that if I put all the money there, then my risk is going to be 20%. Okay, but if I put 1/4 of my capital on that particular stock, then it becomes 5%, right? So again, it's money management coming together, right? So the risk is basically you manage it, right? Although the stop loss may be big, and I never believe in putting tight stop loss because you know what, you'll get stop up more often than you actually make money. Okay, so I prefer to have maybe a bigger stop loss, and that stop loss I use indicators to tell me, because the indicators basically just follow the market, and if the market says something is going wrong, then you better cut loss, right? But it's because it's lagging, it's a bit delayed, so you will never get a tight 3%, 4% stop loss. The only way we can manage that percentage is how much you put in. That's how I trade. Yeah.
Yeah. Look, for those viewers here who have just joined us, I just want to make a very quick shout out. I think Benny said earlier that please join our charity.equitystracker.com. This is to help those that have been most affected by COVID-19. We are running a charity program where our e-learning that we put it up absolutely free for you as long as you donate. Yeah, so there are still people who have been very badly affected by COVID-19. So we urge all our viewers and investors, please be generous. You can pick your own charity. Or if you don't have any lists, you can come and check out charity.equitystracker.com. Just donate to them directly. Please don't give us any money. We only just want to see your proof of receipt, and that's it. And what you do is you get free access to ET Online Campus, which is our online e-learning portal where Benny and myself will be there once a week, where we will be mentoring you guys absolutely free. And on top of that, for 100 ringgit minimum donation, you can bring 3 friends as well. Yeah, and so far we have actually raised. Well, you guys have actually raised. We didn't do much, right? You guys have actually come together. And, we've raised 141,000, and this is in a matter of 6 weeks. Yeah, so you guys have done really well. So if you think you have, maybe a present, right? Tomorrow's Mother's Day, right? So surprise your mom with a donation and free e-learning courses by Equities Tracker, right? Or you guys could do it together. But this is something that we are continuously promoting, and we will be there to support you as well on the ET Online campus, right? So if you're an existing subscriber, you also can join for free. We just encourage, if you can support our cause, to give a donation to any charity. We will be very grateful. Yeah.
Can I just add to this a little bit, Alvin? Because there are a lot of questions regarding to people asking about stocks and so on and so forth. Now, we actually scan the questions, and the reason why we do not want to answer you, because we want to get into the topic, which is basically looking at the pitfalls and how we can improve the things. But if you're asking personal stocks, like what stocks you want to look at and so on, I think it's best you come into our ET Online campus, because that's where we can actually focus on the learning itself, right? That's where you can actually learn more. And like Alvin just said, this is for charity purposes. You pay 100 ringgit or not pay. You donate 100 ringgit, right? And you are able to bring 3 friends into our ET Online campus. And this is where, like Alvin said, myself and Alvin will be there on a weekly basis, once a week, to actually provide that mentorship, that support for you guys. So that will be the best avenue actually for us to ask these kind of questions, all right? So the reason why I bring this up, because there's so many questions on stocks and all that. Okay? So yeah, so please do join. Yeah.
So Monday, but we're back tomorrow night, so you can ask many questions. Before we wrap up, I just want to very quickly introduce. For those of you who sign up for a free trial, you can sign up for a free trial at Equities Tracker. It is you just send us a WhatsApp at +603-840-2070. You get a free access to ET for 2 weeks, or you can go to equitiestracker.com/free. You get free access to Equities Tracker, absolutely free for 2 weeks. So I suggest you guys do that as well. For those of you who have been on the 2 weeks and you guys are thinking to subscribe, this is a new combo package we came out last week. Just a very quick one. We call it the Genius Package, right? So now everybody can be a stock market genius. What we include in there is your 10-year financial numbers, which is all factual, which is what we talked about, which was what I showed you about JCY earlier as well, right? So to be a successful investor, you guys actually need financial numbers or facts, right? So all that is actually there for you, part of that combo package. On top of that, we also have this thing called your Portfolio Manager, which is your sidekick. Look, no investor, like what Benny was talking about, no investor should be investing in only stocks, but you actually need to be managing your portfolio. So we've actually created a portfolio. You can create your own portfolio, and you can track up to 5 different portfolios, right? So imagine if you have 3 different broking accounts, you set up you can start tracking your portfolios here, and it actually gives you a bird's eye view of all your portfolio consolidated into one, right? On top of that, we actually launched 2 things. We actually launched a new Genius portfolio, which we started on Monday, 4th of May. And this is a portfolio purely for educational purposes. This is a 10K portfolio. And the whole idea is this, right? We wanted to use this as an educational as to what can we do to use this, to use what we use in value investing, put into a portfolio. This is actually real money, and it gets updated every day, right? So you actually can see what we do. This is purely only for educational purposes, yeah. On top of that, we actually created another portfolio called Sharia portfolio, where it's only Sharia stocks. And we put them side by side to see how well they do. So one is real money, one is paper trading, but you actually get access and you can view what are the actions that we do inside there. On top of that, a part of the Genius package, you also get all the research that we do. Like today, we've just had a 2.5-hour session on Malaysia's semiconductor industry. What really drives the demand, right? And I believe a lot of you guys who've tuned in, you would have found it very useful. So we do this at least once a month. We invite CEOs, we talk to them so that you get access to these guys as well. This is an exclusive thing that we do. So all this, if you put the whole combo together, it's a pure online subscription. It only costs you 240 ringgit a month if you choose to subscribe monthly. if you do a full 1 year package, and you sign up, you save $40 a month, which is $480 a year. On top of that, you get a free Equity Striker T-shirt, right? If you sign up for the 1 year package, the T-shirt is yours. Don't sign up for 1 month and ask us for a T-shirt because it defeats the purpose, right? So that's the bonus. So all these prices are excluding SST. Just so you guys a heads up, right? So if you guys need some help, send us a WhatsApp, Facebook messages. Send us a WhatsApp on 803-8408-2070. Click live chat to talk to us, or you could also call us on that number 03-8408-2070. All right. Okay. Do we have a couple more questions before we wrap up?
Yeah, I think we can conclude, because what I think people want to know is what would be your last or your advice, based on the mistakes that you make, for the audience, not to repeat the mistake. What would be your advice?
Not a mistake.
Yeah. So maybe I start first, because this I think is what you guys have got as well.
Yeah.
Okay, so I already mentioned earlier, right? Because remember I told earlier when I told you about opinions and following the market is totally different thing. I can give an opinion, everybody can give an opinion, right? But at the end, what is going to be right, what's going to be the fact and figures is the data itself, right? Whether it's fundamentals or whether it's price data. Instead of following your instinct, following your opinions, for me, it's better to be data driven, right? Based on the current data that we have. So please, if you have certain opinions, I think like Alvin also, earlier talked about, he could have actually made more money if he have not followed his own opinion. So for me, that's my biggest takeaway. Follow the market, follow the data instead of following your own opinion.
Peter?
I think my biggest takeaway is you really need to understand the company that you invested in. As I mentioned, I mean, I've also experienced experiences where I didn't sell where the thing crashed, or I didn't sell, the thing crashed and the thing bounced back. So all these various risks. So to me, somehow I think there's really no fixed conclusion on whether should you take profit or should you not take profit. I think to me, what is more important is you as an investor, do you know the companies well enough? If you know the company well enough, right, and you really done your homework, when the price corrected and you didn't get to sell, but when the price corrected, why not just buy more, provided you really understand the business well. So I think my take is that there's really no fixed rule in the sense of when you should sell or when you should buy or when you should cut loss or anything. I think ultimately it's your own objective. If you say you want to make 30% from this stock or 50% stock, you already have that intention. Once you hit that number, sell. Then no matter how high the stock goes, no pain for you, because what is more important is you have met the objective. Right? I think to me that's my key takeaway on that.
Actually, my key takeaway really is look, I think going into investing and not expecting that you have any mistakes, I think that's also going to be wrong. You are bound to make mistakes. I think the whole strategy or the whole behind this is very simple, right? Whether you say take money, take profit, or cut loss, or get out of this stock, or get into this stock, I think the only thing that can really protect that part, right, is actually a proper constructed portfolio, right? So what if you put money in the stock, the price went up, and then you made some profit, you sold a bit too early, you still made money, right? If the price came down and you lost money and you cut loss, right? If you didn't put 50% of this into one stock, your total portfolio should largely still be intact, right? So I think the emphasis maybe, instead of us being so focused on the individual stocks, we should be a bit more focused on the portfolio, because your portfolio will protect you from some of these pitfalls, right? If it's properly constructed.
All right, guys. I think time's up. So guys, if you want more information on our Genius package, please WhatsApp us or call us at 603-8408-2070. We're gonna pin that comment on the comment section so that you can actually see the number. Okay. If you have any questions at all on the Genius package, we are more gladly to explain to you in further details. All right. And for those who wants to learn more and you have not attended or you have not gone to any workshops or seminars about learning how to invest, please join us in our ET online campus, and it's free as long as you make a donation. All right, so just go to charity.equitystriker.com. So all of these you can find the information on the comment section, which is pinned there. So just click on that comment and you should be able to get the details. All right, so guys, it's been really a pleasure and having you guys, and thank you for joining us tonight. And we're gonna see you again tomorrow, and basically every single day, right? So we're gonna see you again as well at 8 p.m. So please like our Facebook page to get notification, right? Please like, and follow us, okay? And we'll see you again tomorrow. And basically all of us will be here, including Mr. Ricky Ng from Mandarin side from Penang, will be joining us tomorrow on Ask Us Anything Sunday. All right, so till then, thank you very much again for joining us, and we'll see you again tomorrow night. Have a good evening.
All right, thanks guys. Bye-bye. Good night.